Well, thanks so much for tuning into today's talking point. Well, I'm about to get on a guest who, at the end of March, beginning April, turned constructive on equities. The beauty is that he manages a very large, or he heads the bond portfolio, the fixed income portfolio for one of the largest AMCs, and talks about both the debt markets and the equity markets with equal gusto. All through the last 9 months that I've spoken to him, Maneesh Dangi has, at various points of times, elicited his views about why he remains constructive on equities, and those views have turned out to be true. Post the budget, let's get him in on the show to talk about his thoughts on what he made of the budget. What does it do for the economy? What does it do for all asset classes? Maneesh, really good having you. Thanks so much for joining in. Now I can see you. Maneesh, it would be fair to say you got it spot on. The question is, here on, after we've had such a major event out of the way, which actually turned out to be much more positive than what anybody was working with, how does the construct stack up?
Morning, Neeraj. So, I mean, if you talk budget, its relevance is generally limited because it's a general planning exercise that you and I would have in our firms. So the importance, at least the way media and some of us try and talk about it as if it's so important. It's not, but nonetheless it's important to emphasize that this budget was a sort of a big deal. Not because the routine stuff that they talked of in terms of some spending here and there, but I think there was a clear-cut ideological shift in the way the government of the day is thinking. Okay, which is a very, very welcome change. Ideological shift in terms of many things. One is public debt policy. In a political economy of ours, the learnings of 1992 and then more specifically after GFC, the learning was that okay, let's run tight budget deficits, because more budget deficit means more inflation. More inflation eventually means that the incumbents actually lose. So therefore, despite the fact that for last 4-5 years our economy performance was underwhelming, the budget deficits were relatively tighter. So first of all, this whole constraint has been sort of, now they've gotten over it, and we're talking of relatively loose fiscal policies, not for this year, but for next 4-5 years. So that's a big positive move, I would say, for an economy like us, because I'm not a debt hawk, and I think I've discussed with you many times that there are no binding constraints for debt, outside of inflation. The other, big thing about the budget is, it comes forward unabashedly talking about, privatization. Again, big deal. Remember 2002, 2003, those days, when first time Vajpayee government talked about it, there was so much of ruckus. Nothing of that sort is happening right now. The smaller change is like, there's no change in taxes. Again, a great deal, because bureaucrats and the ministers love to sort of tweak in taxes in a manner that irritates markets and corporate. Nothing that sort is happening. And the final big deal, I think, and we can discuss in detail here, is that no demand push, and all sorts of policies are simply to supplement supply side. So very, very China-like, East India-like policies construct is there in place. Narega spend has been cut. Large spending is actually going for capex, and so it's a bit of a build India project, which is unraveling in front of us. At least if the budget has to be believed and executed well. So purely needed from a budget standpoint, I think it's a watershed moment. I think I've talked about it, that if you don't want to see it as an early 90s budget of Manmohan Singh, then I think it's at least like a 1997 budget. And I'm absolutely glad that the country has actually taken a small turn, but a meaningful one, and it would keep us in very good stead.
Yeah, actually, I mean, the budget day gains were the best since 1997, if not then 1991. So in that sense, it's interesting, at least from an equity markets perspective. A couple of follow-ups out there, Manish. And the fear pre-budget was that if the budget is, in a sense, uh, going out there and spending for capex, for infrastructure, etc., at a time when the receipts may not be perfectly predictable and maybe a bit uncertain, then what would the move from the rating agencies be, and what impact could that have on the borrowing profile, etc., etc., and then subsequently to corporate borrowing, etc., etc., etc. Do you reckon, I mean, that when they've gone out and done this, what they've done, which is the glide path provided by but higher deficits, etc., in some sense they would have taken into account the reactions or repercussions of possible rating agencies' actions, or do you don't think that this would essentially warrant one? Because I think S&P came out and said also that they are fine with what they have seen.
True, Neeraj. I think we got the equation wrong for a very long time. It's the causality, and I think the chief economic advisor puts it eloquently that causality is that more growth means low debt, not the low debt means more growth. Okay, so the causality is very different, and we pursued the policies of tight fiscal construct as if the just bringing down the fiscal deficit itself would yield us high growth. I mean, that's untrue, of course. And so I think good news for us is that bureaucrats and ministers are waking up to this new reality. And the tyranny of rating agency today is I mean, there's a reasonable response to it now that, come on guys, have a look at our balance sheets numbers, the total debt, and we borrow very little from rest of the world. Most countries, that at least I know of, including the developed ones, have defaulted many times over in last couple of 100 years, and India has had an impeccable track record. I think we're fine. Our nominal GDP growth, I don't remember, but briefly in early 2000s, nominal GDP growth has always been higher than interest. Our primary deficits have not been very high, which is what is relevant. And our public debt, of course, is high, Neeraj, relative to emerging market counterparts, but that's a legacy issue. In Nehruvian era, the first 40, 50 years, we tried to build India through public spending, and that led to relatively higher public debt. But we haven't actually accumulated debt over the last 30, 40 years as a percentage of GDP. So it's fine, so give it a break and move on. So I think that's the approach that minister and the government has taken, and rating agencies blinked.
In which case, Manish, let me ask you, the proof of the pudding would be in the eating, right? So yes, the groundwork of sorts, or the framework of sorts, let me put it that way, has been laid out by the finance minister in what a lot of people are, of course, hailing as one of the best budgets, as you said as well. Now, what should the public policy be like going ahead? What kind of execution, what kind of noises would you want to hear to kind of see that the next 12 months, let's call it 12 months until the next budget, but let's say for the next 12 months or next 18 months, would you want to hear, in order to see that the optimism that has come in kind of sees its way on the ground as well? We, of course, have the RBI policy as well tomorrow, so that will be not strictly from the government side, but one more power body laying out what it thinks. So lay both of these construct out for us. One, public policy, and then do you anticipate the Reserve Bank of India, which I thought has done a fabulous job till now, to kind of further push this momentum that we've had?
So first of all, leaders, thanks. That at least you're talking of next 1 year, because routinely the idea is what do you think next day? Okay, so from a public policy standpoint, a very, very large shift that has taken place is at least sort of beginning to guide you that let's think relatively longish, and even in budget, most allocations for most policies are talking of 4-5 years. That's the way forward, because in health, let's say if I say that I'm going to spend 10,000 crore this year, No one wakes up to this, that, okay, what do you mean by this 10,000 crore? But when you say that, okay, next 5 years, I'm going to spend 65,000 crore, a firm would wake up to this and say that, oh, thank goodness there is a plan. And, can I stitch something around it so that, in the budget construct, what is being an outlay from a public exchequer, I can also sort of plug in and, make some money out of it and create a good business around. So I think the point that I did not mention, but at least there is a reasonable conversation of a longish term, even in the budget. Okay, that's good. Now, what do I expect from the government is execute, Neeraj, again, I don't know whether you would like to hear that, but the point is that the construct of the way government is being run right now, at least ideologically, let's understand this, that it's a little bit of an emulation of East Asia, most specifically China, to a certain extent Singapore, which is what is that? Basically, the construct is that, the two parts to it. One is that the whole of government approach, okay, which is what I would include your second question also in this. Whole of government means that everything in the country, okay, there are no separate departments and independent organizations. The whole of government works together to facilitate for the growth, and essentially it's about creating champions of some sorts in businesses, okay. Everything else will join the forces, in a sense that, if I set up great businesses, electronics, pharma, IT, people would benefit in any case. So the government's approach, unlike the egalitarian West, okay, which is Europe, US, the East Asia approach has been that, okay, let me build champions. Japanese did in 70s, China did in 90s and 2000s, Korea did in 60s. 60s and 70s. So basically, the approach is going to be whole of government. So I expect this good news that, Planning Commission or Niti Aayog, Finance Ministry, Roads, Transports, Railways, RBI, all of them working together. Now, why RBI? Because, here we are trying to do PLI, we are trying to cut taxes. Imagine a world in which RBI say, I want to be independent. So much money is coming to this country. I do not want this headache, and so therefore I will let the currency appreciate. Lo and behold, I mean, all the story that, in North Block is trying to construct is gone, because the very comparative advantage that you relied upon to build manufacturing of mobile in India, or wearables or electronics or pharma, withers because your currency has become super expensive. That's the mistake that we made again and again and again and again. So this time, even RBI is behaving like part of a government and say, no, irrespective of the tens and hundreds of $1 billion come in this country, we will let the currency stay at 73 or 72, 74 range, so that, we do not lose the advantage. The BOP surpluses should not be able to make my country so rich in terms of valuation that my products become relatively expensive for the rest of the world. From the government, I want this whole of government approach continue. The mobilization state that, we have embarked upon, that, the Modi government, what is the key difference between this 5-6 years and the previous, many governments that we've had, is that again an East Asian emulation, that let's mobilize the state, to build toilets, to get electricity, to get the basic services to people, JAM, which is Aadhaar and bank accounts. The state is being mobilized to deliver services. Now, China has done a beautiful thing in last many years to mobilize state and actually improve the outcome. I think this is what the government has embarked upon. Early days, Neeraj. Not sure, we will be as successful as China, but at least we've taking a bit of a detour. So just a last summary line, Neeraj, that I would expect from the government, that what they put out, they please execute the national infrastructure pipeline of 100 lakh crores over 5 years. Great numbers, all aggregated from sort of not a vision document, but small, projects have been accumulated. Now go and execute them. Build roads, ports, and Jal Jeevan machine has to be executed. And that is a problem in India, that we are great at vision, but somewhat sort of poorer in executing. I hope we are able to sort of deliver this.
Manish, just one question: is there and the definitions of short term and long term kind of change in this? But is there in this whole system of the whole machinery working together, including what has been largely an autonomous body like the Reserve Bank of India, coming together and moving along the government's vision as opposed to being independent? My question is there a long-term risk to this? Because there are times when the central bank action, if they don't go in line with the with the North Block action, may actually help in the job that the RBI is supposed to do as well. So is there a long-term risk? Because once the institution takes a turn towards a particular mindset, it's very difficult for it to again get back to what it, as the purists would say, is the principal job of the Reserve Bank.
Beautiful point, Neeraj. It's absolutely right that if everyone the approach is cohesive, and all of the government is ganging up to achieve something in a certain direction, it's great as long as the direction is right. But if the direction is wrong, you're doomed. So, are we right? Did 1970s, the socialist policies were right? The whole of government approach was again taken then, okay? Emulating USSR of the world then. In hindsight, know that it was a catastrophe, okay? Who knows that, emulating East Asia today, Singapore or Japan, Korea or China, of all the people, those are authoritarian sort of capitalism states, okay? Now, whether that is right, this whole mercantilist policy of actually keeping currency at a certain level, essentially what is it doing? It's robbing our consumer from purchasing power. The iPhone that you bought, let's say at 50,000, you could have actually bought at 45,000 if the currency had appreciated. So what is it doing to Neeraj? It's making iPhone expensive. Now, the thing is, it's right that, if these approaches are not independent, they're not going to be neutralizing each other for the mistakes or the errors that the one side is making. So that's the cost, and which is the Western model, right? That let everyone, this whole invisible hand idea of Adam Smith, and not really exactly a parallel I'm drawing, but nonetheless, all the institutions work independently for the very purpose they've been created, and then hopefully the outcome will be good. But then that's a slow process. You can't create China in 30 years, it'll take 200 years. Okay, so it's a big bet. Who knows whether the bet is right or not? You and I are today debating whether that bet is right. I think it's the right bet right now. The decision that we have taken, which is not redistributionary state, not distributing money to poor, but actually creating businesses so that everyone gets lifted. Approach of the state is to cut taxes and actually pay to businesses. You see, today the government of the day is actually often accused by many of us as if it's actually taken a huge socialistic turn.
Yes.
You actually watch government. Don't listen to them. Watch them. And you realize that it's for business government. And good Lord, we have a for business government, because that's the only way that, my country's poor would be lifted out of poverty.
Yeah, that's true. That's true. And I think a lot of people probably mistakenly believe that the socialist agenda helps the poor. Maybe it doesn't, because we've seen for the past few years, the job creation has languished because of that. Hopefully this changes it. Okay, Maneesh, any other point that I've missed? Because I would want to move on to the next question of equities as well. While you look at fixed income so closely, you have this very nice thought on equities, and I want to bring out that whole idea about whether we seem to be in a bubble or not. But anything else in the budget or policy that stood out for you, or you would keenly watch out for?
No, you guys have already commented, that the budget has done kitchen sinking. Good news. It's not. Most economists notes it actually dominate this idea of clean up. I don't much care about it. Everyone knew what was the double budget deficit irrespective of what government was telling us, because, we are analysts and our job is to sort of put numbers together to actually know what the budget is. I think the only thing in the budget, Neeraj, that I think perhaps emphasize is this idea of bad bank and DFI. And I know it's been discussed, so I'm not going to get into the details of it. These are great ideas. Not exactly what you call the Norwegian, the Swedens of the world did it, but it's somewhat different. And bad bank in India is the way it's being envisaged is not going to release capital of State Bank of India, Bank of Baroda, and many of the PSU banks. But what he'll do is that if these bad assets which are sitting in the balance sheets of these banks are passed on to this so-called bad bank, it will free up my human capital. Okay, and along with another idea called DFI, which is sort of another NIF or 100 other things that we have flirted with in last many years to sort of develop institution. Imagine if they are successful, and because it's good that the finance minister put out a target of 5 lakh crore in 3 years' time. Because remember, when Arun Jaitley ji talked about a NIF, it took 3 years to get get life, and nothing has happened after that. Very little. This DFI. So between two, let me give you a line here that is an important one. Is that banks are not in the business of project finance, Neeraj. They don't know it very well. They don't have the liability profile to fund projects. Okay, they're far too transparent, and they do not have the capability to run that kind of risk, especially in a country like India. So they now have this beautiful system where they will pass on all the bad banks, so so that my whole human resources in the PSU banks, which is clocked up right now in dealing with the large stress asset, is freed up. And then they're also freed up from doing this, great project finance, which is too risky. So what do my PSU banks do now? They do what they do the best, and they perhaps are as good, if not better, than private banks, and which is working capital financing, which is retail loans, mortgages. These are rule-based lending, and my friends in PSU banks can do as well as private banks. So here comes an opportunity in India that finally we have this whole PSU banking setup, good bankers, okay, seriously good set of bankers. So many relatives of mine, when I talk to them, and I'm impressed, the kind of banking and the stuff that they talk. They can now focus, Neeraj, on real thing that they are good at. And therefore, there is an opportunity for SBIs and BOBs and PNBs and Canaras of the world to grow very rapidly. So here is my bet, Neeraj, that the PSU banks over next 10 years, okay, will actually gain market share, okay, in credit. It's a contra, but I'm telling you this, contrary to what everyone expects on street, 99 out of 100 people, that PSU banks would continue to lose steam. They will actually gain market share because now they're being allowed to do something that they can do easily. Okay, they have a competitive advantage there in actually doing rule-based lending. There's a trust that they have. Their borrowing cost is somewhat smaller and lower than that of private banks. They can actually crank up retail credit very well. So therefore, embrace times of next 10, 15 years where PSU banks can flourish again. And I think they will do very well.
Well, and it's great for us consumers as well, Maneesh. Aside of the investors bit, the consumers bit as well, because hitherto it was almost written off. Private banks could do whatever they want because they kind of had this belief that the upper crust will believe more in a private bank as opposed to the PSU bank. And it'll be great to see if that changes. But since you have embarked upon that conversation, Maneesh, let me ask you, what do you think about this whole argument of equities being the way they are, inflated, very high multiples, albeit backed by easy liquidity, and therefore now a lot of the street kind of knows that yes, this may well continue, but they still, at the slightest mention of a higher PE multiple, the street does get a bit nervous. How do you explain the equities construct? Are we close to a bubble? Why or why not? What could it take to spoil the party? And actually, can the party continue and intensify over the next 12 to 24 months or maybe longer?
Dheeraj, incidentally, I actually, Jeremy Grantham wrote a report, a few weeks ago, I think beginning Jan, and, in response to that, I actually wrote about a week ago that, why equity is not a bubble. So, please have a look at it. But the point is, I have this argument for last 9 months, even in July, August, I've had this argument with eminent people. We had our governor coming and telling in the beginning of August that, there is an irrational exuberance, and so on and so forth. There isn't. Okay, so people who understand, equity, debt, commodity, everything is part of a simple construct, which is basically valuing future cash flows or financial assets by sort of projecting cash flows and discounting them, isn't it? And so the chief argument that I hear, Neeraj, in the summary, okay, in 2 minutes I'll tell you, is from a macro people like me, okay. The argument is they know that over the last 100 years, almost all bull markets have been pricked by central bankers, okay. Consider this as almost like a rule, okay. If you don't know anything else, just consider this as a rule that if there is a boom in the economy, it would be typically pricked by central bankers, okay. Otherwise, in the debt-based systems, the way we are, the euphoria or the boom or the expansion would continue, okay. So now, why do central bankers come and prick it? Is because they have a mandate to manage inflation, okay, and they have a certain target. In India's case, there's 2 to 6%. In Europe and US, it's 2% centric. Most developed countries are 2% centric. So if the inflation is already running hot or is likely to run hot because capacity utilizations are rising, wages are rising, and therefore the inflation is likely to go up, and therefore central bankers come forward and prick the boom by hiking interest rates, okay. That hiking interest rates actually reduce the velocity of money, and in general, economy begins to slow down. Invariably, because these are debt-based systems, we have very high debt, high interest rates results in some sort of recession or deep slowdown, okay? And that is how markets collapse eventually, okay? Invariably, almost about 85% of the recessions statistically happen in recession, okay? So it's almost like, very good efficacy of sort of vaccine terminology. Okay, recession means what do you call markets busting. Now the argument is that I hear unless inflation. So I'm giving you a construct of a macro that until inflation is returning or is likely to return, in the view of central bankers, they will not prick the expansion. I am not arguing about expansion because everyone knows now, 6-8 months ago when we discussed, it was a novelty when I said that there's going to be V-shaped recovery. Everyone is talking about it. Now, everyone, the macro people, I call them people from Inflanistan, are actually telling us that now because there is so much expansion happening and so much money has been created and the markets have gone up so much that eventually it will mean that inflation returns, and therefore the central bankers will come forward to do taper, come forward to hike interest rates. So now, is there a case of inflation right now? Okay, so I gave you a construct of how to cite a bust in equity markets. Until you get a sight of central bankers coming and pricking the boom, don't get out of equity. Okay. Now, when will they come? Is when the inflation returns. So therefore, now all that you and I need to discuss is that whether inflation is returning. Okay. Now the problem with inflation returning, this garvapsi of inflation. There are two things. One is that for 40-50 years since 1980s, it's been elusive. It's not come in developed countries, at least. I'll talk about India just in a while, but it's not come in developed country for a variety of reasons. Debt, demographics, and technological disruptions and many other things are the reasons why inflation has not returned. I have absolutely nothing on paper right now to see inflation returning. Our wage markets are, a labor market slack is still there. There are far too many people still unemployed. The technological disruptions are underway. Perhaps this once in 100-year kind of stuff is happening in the tech world, which is actually resulting in higher productivity growth. All of that means that the wages are unlikely to tick up in any meaningful fashion. Again, just for a construct, inflation only returns when the wages go up. Okay, it doesn't return because copper prices will go up. Again, mistaken beliefs. People say, look at oil, it's $60, therefore inflation will come. Come on, guys. Oil moved from $10 to $100 between 2002 2007. There was no inflation in the world. 10 times. We had mother of all booms in commodity markets in those 5 years and no inflation in the first 4-5 years. So similarly, right now, commodities cannot be linked to inflation. S&P 500 and Nifty cannot be linked to inflation. The wealth effects statistically do not corroborate this idea that it relates with CPI, which is consumer inflation. You get my point, Neeraj? So basically, I don't think until the labor market slack is over, which basically means the unemployment numbers fall dramatically, so that you and I are beginning to renegotiate wages from our respective employers better, that for every two demand of Neeraj, there is only one Neeraj. And that is when the wages start to spike up and inflation begins. Okay. If you see that, Neeraj, that is more like a 2023 story, please get out of equity then. Otherwise, this argument of Inflanistan, is right now null and void. Again, let's keep our eyes closed, open, sorry.
Open.
So that over next couple of years, as and when we cite it, get out, okay? So macro guy, Neeraj, just a minute, a macro guy buys valuation, at least people like me, and sell macro, okay? So buy markets when they are really sasta and sell them when the macro has turned bad, okay? And macro turn bad means inflation. Inflation, it will only come when the wages start to spiral up. They only will spiral up when the employment numbers actually go up and unemployment numbers fall dramatically. That's more of a 2-year, 3-year-old out story. So that's the macro, explanation of people who worry about markets bubbly right now. We'll talk about P, but I thought, you had a question.
Yeah, just one quick follow-up, Maneesh. So agreed that the CPI may not be rearing its head, and as per the current data. But for commodity prices to move up in a scenario wherein the supply side is not too disrupted, right? If the commodity prices move up, that would move up because there is demand coming back. And if demand is coming back, then the whole labor machinery is working towards producing that. The purchasing power moves up. And therefore, that's a precursor to inflation moving up, isn't it? CPI moving up as well. So sure, it may not move up in the same pace as WPI, but it will follow very, very soon, right?
Yeah. So Neeraj, the commodities role, you will be surprised that most of the developed countries, what is surprising to all of us as bond watchers is that every day in 2003, 4, 5, 6, 7, the oil would go up, or even as recently in 2012, actually the US treasuries will come down. So higher oil price, I know you will not believe, but once you think enough, you will realize this actually is deflationary. Because it actually robs you of purchasing power, that the very burger that you could have had, an extra burger, you run out of that money. Okay. So higher oil price, okay, ceteris paribus is deflationary. Okay. As long as it's not coinciding with higher supply of money, in general, more commodity price does not lead to high inflation in evolved economy. It does in India. And I'm not saying for once that, $80, $90 is not going to be bad. So India's macro construct is somewhat more nuanced, okay? But I was talking about a developed market construct. And by the way, that is what is important for equity markets. India's construct is relatively less important.
Yeah, I buy that point. Okay, so let's talk about the other half, Maneesh, which is the multiples. Right now, the multiples, the skeptic would argue that never mind how bullish you are about the economic growth, And we kind of have now established that the equity markets and the economy probably don't have too much in common necessarily so all the time. The multiples are definitely expensive on a TTM basis. And what the future throws up is still up in the air.
That's true. I mean, see, again, Neeraj, this is where, the difference lies in the way I think is that, look, absolute P multiple reveal a few, but, hides a lot of things. It hides the backdrop that, you sit in. Okay. While the P multiples are perhaps at one of the highest level, briefly only in 2007 and 2000s, in the world, the P multiples were actually higher. But then they have to be contextualized to something very important. And because the counterpart of P multiple is actually yield. Okay. If yields are so low, Neeraj, then the P's have to expand accordingly, because P is what? Just the opposite of earning yield, So how can you have, let's say, a government bond yield is at 10%. Okay. What do you seek from equity? Equity risk premia, isn't it? Let's say you want 6% equity risk premia. So accordingly, the ask yield from equity will be 16%. But imagine if the government bond yield is at 0. Would you still ask 16 and a corresponding P, or would you simply ask a 6% earning yield? Okay. So basically, P and price to book have to be contextualized in with respect to what you call it, where the yields are. That's one, Neeraj. Number two is that yields are low, but then again, nominal yields are hiding something. And what are they hiding? They're hiding something called real yield. And for equities, people who actually practice equity and know the math of it, they know this, that nominal yields don't matter for equities. The real yields matter because, just for your audience, the nominal yields fall, but then it essentially means that the growth is falling. Therefore, the cash flows will also fall. So both numerator and denominator, that gets adjusted. But what if the real yield fall? That means that the earning power of a firm is falling, but the discounting yield is falling even more. That's what you call it, real yield. So what has happened in the world today? What has happened in the world today, Neeraj, is that in last many years that I have seen, only first time I'm seeing that pretty much entire OECD, and to a large extent some few EMs that are important ones, the real yields are negative. In fact, the US Treasury and many other bond yields have actually inched up in last 3 months, but real yields have actually fallen because the expected inflation has risen. You see, the nominal yield equals to break even, inflation plus real yield. So if nominal yields rise, but if inflation also rises or expected inflation also rises, then the real yields are actually falling to that extent, isn't it? So basically what it means is that if the real yields are falling, the equity prices have to adjust that. Now, just for you and everyone to understand this, that equity and bonds are not materially different. They're actually bonds only. And in bond, equity is nothing but, let's say, if you're earning at 1.5-2% dividend yield and 8-10% of growth, it's nothing but a 40-45 year bond, duration bond. So if a real yield for ceteris paribus falls by 1%, the equity price has to adjust by 45% higher, because that's the way the bond math works. Okay, so that is the argument against the people from P Stan that they quote P and with respect to the history, but they don't place P with respect to something which is the what do you call bedrock, of where the P sits, and which is the yield, and more importantly, real yield. So which is why I'm not at all saying, and I think I made this point many times, that markets are expensive, Neeraj, but they're not at all bubbly. And which is why, people month after month have told me since July, August that, markets are bubbly. And bubble means what, Neeraj? Bubble's definition is that markets are likely to fall by 40-50%. That's not going to happen.
Yeah. Okay. Thanks for explaining that construct as well, Maneesh. The final piece of this conversation, therefore, having done all of this, is the other variables. So let's work with this assumption that all the pieces of the government are working together in tandem to ensure that growth comes back and firms do very well, which is great. and that the markets are not in a bubble territory. What about the other variables? We've briefly discussed about commodities. What about the currency? The general belief is that the dollar will come off against all currencies or all major currencies, and INR might not be any different. What happens if that happens? Never mind the RBI's efforts to stabilize. What happens if the rupee does appreciate vis-a-vis the dollar? Does it change the equation anything in any fashion? Any other variable that people should be keeping an eye out for?
So, Neeraj, I mean, appreciating dollar will be rejoiced by markets. Appreciating rupee or emerging markets will be rejoiced by markets. Okay, I mean, but it's not a good thing for the country's growth. The low taxes, PLI, and what do you call it, relatively cheap currency, together can fire up our manufacturing. Okay, and I want to highlight this, that if you watch the FDI pipeline today, it is running red hot. Okay, don't be surprised if you get $100 billion of FDI in next 1 year, and that becomes the run rate. Okay, so the role of currency in bringing manufacturing back in the country is absolutely important. Remember this, again, a little bit of a history talk here, that post WTO, okay, there is very little the country can do in terms of tariff. Okay, a little bit of tinkering here and there that this government has done, but little. Okay, is nowhere close to what we used to do in 80s and 90s. Okay, so what is the only tool left to balance your economic pricing power, okay, of anything, that the cup that you produce or the mouse or the computer that you produce, is the currency. If you let your currency relatively depreciate, your stuff becomes relatively cheaper, and therefore you can gain market share. Fire it up with low taxes and PLIs, and you will have a magic. So I think it's important that while the huge amount of FDI, FII, and equity would continue to push currency higher, which is appreciate, it's important that RBI intervenes aggressively throughout until we are called out as manipulators, like Vietnam has been called out. And then also we'll discuss with US Treasury then, and maybe spend another 2 years. But please continue with this, so that we can recreate manufacturing here of this areas that PLI scheme has identified. But again, the path of least resistance for the currency, Neeraj, is still appreciation. Remember this, that year after year over last 40, 50 years, the basic construct was, because our inflation is relatively higher and we run a large amount of current account deficit, and that our NIIP, the net investment position, is very negative, the path of least resistance for our currency was always depreciation. Okay, at a run rate of 3-4%, or sometimes even more. Every crisis we would depreciate by 20-30%. That's not going to happen, Neeraj, over next 10 years. Okay, because of the kind of reserve that we are accumulating, and then relative position that we have with the rest of the world. So okay, so that's the thing. If RBI plays the ball, currency stays here. But then another thing kicks in. If the currency is too cheap, then it becomes too cheap for the rest of the world to bring money in. So which essentially, Neeraj, means that our assets will become more expensive eventually. Okay, and that is where my argument is that India today, Indian equity markets or Indian stuff today is much cheaper for outsiders than Indians, and which is why that's the construct I have, that over next many years you will see unprecedented amount of money flowing in the country in some sort of equity, FDI or FII, because RBI is pushing it hard to keep India relatively cheap.
Yeah, well, and we can go on, Maneesh, to be honest, but this was good to just get this basic construct from you about how do you think through some of these variables. I have one final question, Maneesh, and that is that while you look at both the sides, which is both fixed income and equities, I'm asking you an equity question though, and which is that how do you look at valuing certainty of income streams versus a rise from the nadir of income streams, so to say, right? Hitherto, the last decade, the market has predominantly valued certainty and very high multiples given to all of those income streams which look predictable, were high quality, high returns, etc. We now starting to see a small turn in the way the businesses themselves are doing, wherein manufacturing, capex oriented plays are actually coming up. The companies are sounding a lot more confident as well in the con calls, etc. Do you reckon, in your wisdom, that there could be a turn, a shift in the way money flows in towards businesses?
So Neeraj, again, as certainty tends to one, okay, equity tends to become bond. Okay. So, I mean, if it's a certainty is a scale from 0 to 1, as it tends to 1, meaning very certain, as certain that it's almost like a government bond. So it's a bond. And then it tends to 0, near 0, which is lottery, then it's a lottery, So the beauty of the equity market is that it offers 0 and 1 both. Okay. If you have a very uncertain world, very uncertain policy making, very uncertain geopolitical setting, then all the risk money will flock to certain cash flows, which will mean that those certain cash flows will become even more expensive. As the uncertainty drops, as the outlook for growth improves, people look through the near term and begin to think that, oh, this guy is setting up a small airport here. Will eventually 5 years out, a lot of traffic will be there. They will make money after 7 years. Let me price it today. Okay. That becomes possible when, you have a certain world. Okay. So certain world prices uncertainty more. Okay. Uncertain world prices certainty more. Okay. So what did we have since 2010? Far too much uncertainty, Neeraj. If you were in 2010 and I had told you that you will have a policy paralysis, Anna Hazare movement, taper tantrum in 2013, 2016 of demonetization, ILNFS, and whatnot. So much uncertainty. Almost every second year, you had some sort of a big blast happening. So what did you do? You actually bought a lot of these MNCs, that stuff, which does not dilute and create a certain cash flows and valued it at very high multiples. Now, I'm hoping that, what did government say? I am not going to tinker with taxes. Argentina actually did a COVID tax. Hungary did a COVID tax. The government had to come forward, not as a matter of statement. No, we are not tinkering with it. What is it telling you? I'm inducing certainty in tax system. Okay. So, I mean, there are 100 things, but I think the India of tomorrow, which is next 5-10 years, will be relatively more certain. And which is, therefore, Neeraj, you're right that it's fair to begin to reprice uncertainty to that extent. And, those cash flows could be priced better.
Lovely talking to you, Maneesh, today. Thank you so much for your time. This was wonderful. And yeah, we should have you more often. Thanks so much for joining in today.
Thank you. Thank you. Thank you very much.
Pleasure was ours. And viewers, thanks for tuning in to this rather extended session of Talking But I really enjoyed it. I hope you enjoy listening to it and seeing it the way I did. Thanks so much for tuning in today.